What are options? So options are a type of derivative instrument that is based on an asset. So the asset could be a stock, commodity, or whatever. So there are two types of options. There is a call option and a put option. A call option is the right, but not the obligation to buy an asset at a certain strike price, while a put is the right, but not the obligation to sell an asset at a certain strike price. So you can think of a call as kind of a bullish sentiment on a stock, right? And so that means you want or think that the stock is going to go up. While a put option is more of a bearish sentiment towards a stock, commodity, or asset. And this basically means that you want the stock to go down or you think it's going to go down. Now you might be asking, what is a strike price? What is a strike price? Well, a strike price is basically the price where the option, if exercised, you see from the keyword not the obligation, right? So if exercised, that's where it will be exercised from. Let's say we have company XYZ, okay? Let's say this company is currently trading at $90. And let's say we have a call option. So call option is a bullish sentiment on this stock, which means you think that this stock is going to go up. So let's say you have a call option at $100 and it expires 30 days from now. So 30 days until expiration. And basically this 30 days means when this expires, when this option expires, it will be executed 30 days from when you bought it. So we have company XYZ, and let's say during this 30 days, so this company XYZ, and let's say it's at $90 to begin with. So let's call this day 0 and let's call this day 30, right? Okay. So let's say during this time the stock, well, for whatever reason, it goes up, okay? Whatever reason, it goes up. And let's say by the end of the 30 days since you bought the option, it becomes $120. XYZ increases in value from $90 to $120. And we have a call option at $100, okay? So let's say $100 is somewhere like this, okay? $100 is there, okay? Since the price now, after the 30 days, is higher than the 100, so 120 is greater than 100, this means that your option is in the money. And this basically means that you will make money. But it actually depends, because if you buy a call option, there also must be a seller selling you that call option. So when you buy a call option, an option controls 100 shares of the underlying asset. So let's say you bought one option at $100. This doesn't mean you pay $100, by the way. Let's say, for example, you pay $5 per option, and since it's 100 shares, you pay $500. Now, options might seem like, you might be thinking now like, what if I just buy the stock? I'll make money that way. Well, the thing is, like I was saying, you only spend $500 here. And let's say you wanted to buy the 100 shares at the $100, right? If you didn't use options, you would have to pay $100 times 100 shares, which equals $10,000. And not everyone has these $10,000 lying around. So you can buy an option that gives you these 100 shares, and you can only pay $500. Now you might be thinking, what decides this $500? Well, there are two factors in deciding the price of an option. There's called the time factor, or as people call it, it's the theta. It's the theta. And there's the intrinsic value, which is basically, let's say the stock was at $120, and let's say you bought the $100 strike price, so the intrinsic value would be $20 per share. So these are some of the factors. It's more complicated than this, but we can simply think of it as these two factors. And so back to the example, how much do you think we would make You might just think it's $100 and it's 120. Well, someone must accept the risk that you are giving to them, and they must get a premium. Basically, a premium, it's basically the total cost of the option. So it includes the intrinsic value and the time factor and others, of course. So let's say the market prices the value per share, the premium per share as $5. It's basically a combination of those factors and implied volatility and other stuff. But basically, intrinsic value, I'll explain this because time factor is basically complicated, because you can think of an option as the closer it is to expiry. Let's say this is 1 year to expiry and this is like 0 days, right? The time factor, like inside an option, becomes less because you have less time to move the stock. Let's say over 1 year, the price can go from $50 to $100, right? Let's say something like that. But if you have like 5 days, right, then the stock can barely move because that's the way volatility works. So maybe it will move from $120 to $125. And this means that if you have an option like way out of the money, like $140, it will basically be worthless or like really cheap, because everyone knows that during these 5 days, it's not going to hit $140. Well, that's obviously in normal circumstances. And basically, the intrinsic value is basically it's the actual value of the option if it was exercised immediately. Let's say the stock is at $115 and you have a call option at $100. This would mean that your intrinsic value would be $15 per share. So back to the earlier example, how much would we actually make from this? Well, let's say the premium was $5, and since you control $5 per share, so per share. And since you control 100 shares, you would pay a $500 premium to whoever is selling you the option. So this is the premium you pay to enter this contract, this call option contract. And let's say it ends off at $120. It expires at $120. You would gain $120 minus by the $100 of the call option, because it allows you, call option basically allows you to buy the stock at $100, and you could immediately sell it at this $120, giving you a $20 per share profit. So that's a $20 profit, right? And since you have 100 shares, right, it would be $20 times by 100, which would equal $2,000 profit, right? So you would have $2,000 profit. But you paid $500 for this option, so it would really be $1,500 profit. And this is assuming all conditions are constant, because they are not. And you might be thinking, why do I use options? Well, as I kind of touched on before, options control 100 shares, and as they said, the premium could be cheap, like $500. And instead of putting up $10,000 of cash, if you're really confident about the stock, you can just put $500 and you can net a $1,500 increase. It's possible. But the risk, there's also risks with options, which I'll cover. So basically, options are a good tool, and the difference between options and normal stock is that you can put less capital, but it is also more risk sometimes. Like this capital that you put can disappear. It could disappear. This capital could basically disappear. Because, for example, like I showed you, this example I showed you is if the stock went up from $100 to $120. Let's say it doesn't go up. Let's say XYZ, okay? Let's say XYZ. This is XYZ. Let's say for whatever reason, what's our details again? So, $100 call option, and it's at $90. Let's say this is $90, and we have a $100 call option, right? It's like above this 90. So let's say the stock goes from $90 for whatever reason. Maybe it has bad earnings, so it drops really badly. And let's say whatever price it ends up, let's say it ends up at $70. And since we're only talking about call options right now, we're only profiting if the stock goes up. We only profit if the stock goes up. And since the stock went down and we have a call option at 100, we're losing money. Now, the thing we're going to look at is how much money are we losing? Well, when you buy a stock, let's say you bought the stock at $100, bad timing, whatever, and you bought 100 shares of this stock. So this is $10,000, right? But now the price went to 70. Let's say you want to cut your losses. Basically, you would lose 10,000 minus 7,000, which is a minus $3,000 loss. Now, instead, if you bought these call options at $100 and they were priced at $5 an option, that's the premium, and they control $5 per share, so per share. And then since each option controls 100 shares, it would be priced at $500. So instead of losing this crazy $3,000, if you go back to our definition, it says not the obligation. And this basically means that you are not obligated to exercise this. You're not obligated to buy this stock and take on the $3,000 loss. You can simply let it expire. You can let expire worthless. You do not have to exercise this option. So your max loss is the premium you paid, which is $500. So you only lose $500 from this. Now you might be thinking, why don't I just put call options on everything? I'll just hope everything goes up. Well, the problem with that is you don't really know, and you might lose a lot of money in all the stocks. Because, example, this is the rare extreme scenarios. Let's say it goes up 20%, this one goes down like 30% or close enough. So what happens if the stock just does nothing? Well, you see, you also lose the premium, because if XYZ just does nothing and then just closes at $90, let's say $100, and then it starts at $100 for this example, you basically lose the premium, because what's the benefit of buying an option to buy the stock at $100 when you could just buy it on the market at $100? So it's useless. The intrinsic value is zero. So who would want to buy this option? So you lose the premium. So I was talking about call options now. Put options are basically the reverse. So if we can go through the examples again. Let's say you had a put option here at $100. If the stock went to $120, you would lose the premium, which is 5 times $100, which is $500. But premiums can really vary or change depending on the time and other factors. But you would basically lose $500 in this scenario where the stock went up, and in this scenario where the stock went down, you would gain the difference between your call option and the expiry date, and then minus the premium, of course. Now, there are actually two types of options. So the type of option I covered here was the European option. There's also American options, which will allow you to exercise the option at any time. This means that, as I was talking earlier, I was talking about at the end, the value at the end. For American options, you're allowed to exercise the option anytime you want, while European options can only be exercised at the time of expiry. So let's give another real world scenario just to hammer it home. So let's say you have $1,000 in your bank account. You basically have a high risk tolerance for this. So you can throw this into some options, okay? And now you should know that the closer to expiry, the more volatility it has. So closer to expiry, there's increased volatility. So you could throw in 0 days till expiration options, which means it basically expires on the same day you buy it. Now this is extremely risky, since the price of the option could vary during the day, because one day it might be in the money, one day it might be out of the money, and the time factor is basically not there. It's basically the intrinsic value only. And the time factor has already decayed. It already decayed. So let's say you're going to put this $1,000 in your bank account. Let's give an example. Let's do ABC's stock, okay? ABC's stock. So let's say you believe that there will be some news during the trading day, right? During the trading day. I don't know how you would figure this out, but just an example, that it would be bearish. So bearish. You could open up put options. So let's say ABC was at $100, right? $100. You could open up a put option, let's say at the same price. Let's say $100 strike price, and it expires on the same day. So 0 days till expiration. This is extremely risky, as I said earlier. So let's say during the day, ABC stock. So let's do this, 9:30 to 4 p.m. So at 4 p.m. or maybe 15 minutes before, options will have to be exercised by the brokers. So let's just assume it's 4 for simplicity. So 4 p.m., 9:30 a.m. So let's say, since it's $100, let's call it $100 here. And let's say it's kind of doing nothing the entire day. So your value of your option is decreasing, because there, even though I said there was little time factor left, there is still a time factor. So you could kind of think of it as, instead of this is the stock might be going straight. Your value of your option is kind of going like this. It's kind of like going down, because this is the time factor. In this same time, it could have moved up, it could have moved down, but since it's moving straight, the time factor is going down, because there's less time for the stock to move. But we can think of it as, let's say there's some horrible news. Let's say there's like a auditor that resigned. Okay, that's really bad for a company. So let's say the stock just suddenly drops. It tanks, right? Let's say it goes to like, what's realistic? We can go like $75, and it just hovers there until 4 p.m. You're at your expiration. Basically, puts are worth, like options are worth less, like the closer and closer it is to the day. I don't know what the premium would be, but let's just call it $1 premium. And you have $1,000, so each controls 100 shares, so that's 100. And let's say you buy 10 options of these, right? So your profit would be $100 minus $75, which is $25. $25 times by 100, which is the amount of shares you control, times by 10. So this would be $25,000 profit minus the amount you paid per option, which is $1,000. So you would gain a $24,000 increase. But in any other scenario, this put is basically a gamble. It's a gamble. And so you would gain this crazy amount. For how much did you risk? You risked a total of $1,000 in your bank account. $1,000. So you went from $1,000 to $24,000 in just less than a day. Less than 1 day. Now you might be thinking, oh, I'll just bet for every company to go down. I'll bet for every company to go down. You're going to lose your premium. It's guaranteed. It's basically guaranteed. It's not really guaranteed, but this is really risky. And it's just a way. This is just another example, of course. There's also other types of options. I've only covered call options and put options. I haven't covered who sells them to you, and I might do that in another video. But there's also different types of call options. There's also the iron condor. There's like a mix. You can do a mix of calls and puts, or you can do a calendar spread. You can do a straddle. There's a lot of types of options you can do, and your profits would look different depending on it. And you can also use this time decay to your advantage, but it's kind of complicated, and I can probably go into it in another video. Last thing I want to say is, options are not just for people like who's doing solely options, just only options. It can be used to hedge. So hedge is basically like, you basically protect your losses using an option. So I can explain it like this. let's say you have company XYZ again, and it's currently trading at $100. You can make a put option at, let's say, a strike price of $80. The lower the strike price is comparing to the current price, the cheaper it is. So if we have, let's say we have a lot of money in our bank account. Let's say we have, let's say, 1,000 shares of XYZ, right? 1,000 shares, and then we have times $100. So we have a total amount of $100,000, right? $100,000 positioned in XYZ. So let's say you buy, how many put options should we buy? We want to buy 10 put options because it would cover 10 times 100, which is 1,000 shares. And so we can buy these put options. And since they would be pretty cheap, because it is really hard for a stock to drop 20%. Let's say we buy these options insuring us for 30 days. So we are insured from the downside for 30 days. I'll show you why we're insured for the downside. Because if you look at your profit, let's say XYZ is here, right? And let's say it's $100. And for whatever reason, it drops to $80 suddenly. Okay? So if you didn't have the option, you would lose $20,000. This is because your stock went down 20%. So you would lose $20,000. Well, if you have the put option, actually it would be better to make the put option at $90 just so it's a little less complicated. Something like that. So let's say the put was at $90. You would basically lose this $20,000, but since you are hedging your position with this put option, so you're basically having a bullish side of the trade, which is holding the stock. Holding the stock is the bullish, and then you have the bearish side, which you can call insurance, which is this option, this sort of option here. So you would lose $20,000. But let's say the premium you paid for the put was, just say $1. So you would pay $1 per option, per share. So it would be like times by 100 times by 10 contracts. So this is options, the amount of options. This is the per share. So per option, there's 100 shares. And so you would cost $1,000 for this premium. So your loss would be minus $20,000 minus $1,000. Right? So you would have a loss of $21,000, but we also have the profit from this put option. So the put option would profit us $90 minus the current price of $80. So it would be $10 per option times by how many shares per option do we have? 1,000. It's 1,000. So we would profit $10,000 from this option that only costed us $1,000. So we would gain $10,000, assuming other factors are constant. So instead of $20,000 loss, we can only incur an $11,000 loss. So this is without option, and this is with. So that's the way you can hedge your positions with options. So in summary, options, these are derivative contracts based on an asset. So it could be a stock, commodity, or even currencies. And there's basically two types: calls, which are bullish, puts, which are bearish. And these options basically control 100 shares of the company, and you can use them as leverage products because it gives you more upside but also more downside sometimes. And there's many risks, like it expiring worthless, time decay, and it being kind of complex and hard to understand. But overall, they are pretty useful, and they are pretty useful instruments, especially for hedging, or if you have little money, like if you only have $1,000. you can make a lot of money if you know something. I don't encourage insider trading, by the way. This is just an example. And that's basically it for Options 101. Hope you enjoyed, learned something, and see you next time. Bye.